Joel Nunez, we coming to you. Unmute yourself. You've been unmuted. What's going on? Let's see how quick. There you go. Joel, what's up?
I'm here. What's good, y'all?
Good. How are you?
Everything good. Everything good.
I'm doing well. I actually knew I was gonna be unmuted today, so I actually wrote down my question so I didn't forget.
Oh man.
So I started reading the Down Low Investor because when Trap was on, he was talking about Manish Papriya. So this goes to anyone who wants to answer it. How do y'all like go about calculating like intrinsic value and terminal value when you like researching a company?
That's a great question. Caleb, you want to take it first?
Yeah, good question. Well, thankfully, there are a lot of screeners that can do that for you, and you can compare one company to another. So if you were to, I'm thinking about some of the screeners that I would use for this. I know Schwab has one where you can do that comparison. There's also some pretty advanced stock screeners out there. I believe maybe Finimize may even do that for you. So there's machines that will do that for you. There's no need to put pen and paper to it. But the point of why you would want to do that is more important. So if you're looking at intrinsic value because you're trying to think that there's maybe some untapped value in the company that's not being appreciated in the stock price, and that's why you want to potentially participate, that's just one thing to look at. But you also have to look at what's happening across that industry and with that company's competitors, because it may not be the fact that it may be priced low because of its intrinsic, there may be some metrics that are not working there. There may be other reasons. So know why you're looking that up before you look it up, but there's plenty of screeners that'll help you pick that out. And you could probably set up a whole watch list of companies, from high to low and intrinsic value or low to high, and then make your picks that way.
There you go. Thanks, Joel. I appreciate you. That was yeah. I'm not sure if we're gonna get any more than that. Joel, appreciate you. Let's go to Mike. My guy Mike. What's going on, Mike? Mike is the number one person in the chat every Monday. Mike, what's going on?
Hey, what's up, everybody? Happy birthday, Ian.
Thank you, brother. I appreciate it.
My question is for Silver. What inspired you on your trading journey? Like, what actually got you started since when you were younger?
Great question, and thanks for joining. You're here all the time, but thanks for being here and thanks for welcoming me. I am my dad is an investment banker, a venture capitalist. I learned a lot just by sort of sitting at his knee, reading a lot of private placement memorandums, learning about companies, going on company visits with him. So that kind of got my interest in business, but I didn't want to be a banker. I didn't want to be a venture capitalist. Too risky for me. I'm a journalist, and I was much more interested in the story and the stories behind companies. So in learning about companies and the storytelling I did, whether I was at Bloomberg Television or my days at CNN Money, really kind of helped teach me how to think about companies and how to learn to invest. And Bloomberg was very instrumental in that, because Bloomberg is beyond a news organization. It is a financial services company with this incredible terminal, but you can't work there. You couldn't work there back in the day when I started at 26 years old without going through what they call Bloomberg University. Thank God you guys have EYL and the UIL University, but you had to learn the way the stock market worked, the way the bond market worked, the way the Federal Reserve worked, the way the options market worked before you could report on it. So I got that deep dive, that dunk in the deep end that got me passionate about investing. And then I also came of age as a young journalist in the internet bubble, where I was watching the rise and fall of what I thought were some of the greatest companies in the world that were blown out of the sky within minutes. And that's something that I'll never forget. Is you could think an AOL, for example, is never going away. AOL's gone.
And it does.
Basically.
Yeah.
Gone. And if you have an AOL email, y'all got to stop playing with it. Reward yourself. Upgrade.
That's pretty cool if you do. I want that t-shirt.
Appreciate you, Mike. Let's go to Maurice. What's going on? Unmute yourself. You've been unmuted. Maurice, you there? Maurice, don't do this. Don't make me do it.
I'll squeeze one in. Caleb, are there any key lessons that you learned from your dad as a venture capitalist that you apply to this day?
Yeah, and one, I think the key one is, when you're looking at companies and you're evaluating companies, you could look at all of those metrics and make sure that everything sort of smells all right, but it's really people that you're investing in. And it's a little bit different with stocks and public companies, but you really want to feel good about that management team one way or the other. You want to feel like they're heading in the right direction. They have strategy. They see around corners. Whether you're going to go to work for a company like that or invest in a company like that, or just make a trade in a company like that, you want to have some conviction in the human beings at the core of it all, because sometimes it really just does come down to that human judgment. And that's what I learned from one of the key lessons I learned from my dad. Good question.
Thank you.
Let me ask you this: as far as how many stocks should be in a person's portfolio? What is your take on it? Ian has a philosophy of 2 tech, 2 index. Some people say 5, some people say 10, some people say 1, focus on just one company. Like, what's your thoughts on a portfolio? Because that's a question that people ask like a lot. Like, how should I, diversify my portfolio? How should I put together my portfolio? What should it be? ETF? Should it be stocks? Should it be indexes? What's your thoughts on making a portfolio?
Yeah, I liked Ian's answer earlier because it does make you focus. If you're only looking at 8 to 10 companies or a few companies in each sector, and you're also thinking about them for short-term, medium-term, long-term, forever term, I like that because it does make you learn that business super well. And you can change your mind on a company and not get emotional and try to hold on to it for life if it doesn't feel right anymore, and rotate out to another company in another sector, or rotate out to an adjacent sector that may have a better opportunity. I like 12 to 20, right, in terms of companies or ETFs, because that's kind of my capacity to manage. I also like to be broadly diversified across industries. And I also like the little nuance industries that ETFs allow you to get exposure to. So it's not like I like all tech, and I'll buy the Qs and I'll buy the other big tech ETFs. But I like some of the adjacent industries that are just on the side of that. I do that with the cannabis industry too. It's not the dispensaries per se or the big retailers. I'm much more interested in the medical, the companies on the fringe of the medical devices and the medical therapies in cannabis, but also the growing systems. I think those are fascinating industries. And also similarly, like I talked about climate change and ESG investing earlier. I'm interested in companies in water preservation, water conservation, water purification. So there's ETFs that service that as well. So I like that fringe aspect. I like my core, which is, the super sectors, but then I like a few of those fringe aspects. So that brings me out to like 20.
What are some of those marijuana ETFs or companies that you are looking at?
Well, there's the canopies of the world and the ones that everybody knows, and the Tilrays of the world. But when I started looking at some of the Israeli cannabis companies that were doing the medical tech on cannabis. Don't ask me to remember the names of them. It was like 3 or 4 years ago. I started buying some of these and some of the ETFs around that. But also, if I wanted that broad exposure, ETF MG, MJ is the ETF, the big cannabis ETF that kind of gives you everything. It's like you want the
YOLO.
growers. YOLO, but started by a friend of ours in the industry, which I got to know right out of the gate when he started that. So I like to look at those, and it's like 31,000 flavors now. It's not 31 flavors; it's 31,000 flavors of ETFs. There's 2 million ETFs out there, so there's a lot to choose from, and you could just literally pick any fringe part of any industry and get exposure to it that way. But you want to make sure when you're buying ETFs that there's liquidity in those ETFs, because those can disappear as fast as a stock, as fast as a penny stock. They can be gone. Make sure there's liquidity, see who's backing it, see how much assets are in there, see the trend of asset flows over time, and make sure you feel comfortable with it, because they could be flying by night as well.
That's very, very important.
Can you talk about that real quick with the liquidity? Because if you remember maybe 2015, like SVXY fell through the floor. And I know a bunch of people that lost $100,000, $200,000 there. How can people check to know if ETF has good liquidity, and then what are some measurements of who they should be backed by?
Yeah, so you want to look you could look at any ETF has a fact sheet, typically if it's brought to you by a responsible issuer, so the State Streets of the world and the Fidelities of the world, and but even some of the smaller players, you'll see a fact sheet. In that fact sheet will be all the statistics you need to care about as a potential investor: AUM, growth of AUM over time, performance over time, industry sector components, the weighting of each company in that sector, and the liquidity. So you don't want an ETF that doesn't have ample liquidity, or that hasn't been battle tested, because we saw that. You mentioned 2015. What about XLO, the big oil ETF? Damn thing almost went negative last year when oil went negative. Whoever thought that could happen? If the money starts flowing out, because remember, ETFs are for retail investors, but they're really used by institutional investors for hedging activity. So if all of a sudden they decide to open the door and jump out with their chutes on, all the liquidity can fall out of that ETF in a minute, and it could be gone. It could go to zero real fast. So you want to make sure there's ample liquidity from a lot of institutions. You could look at the numbers. You want a couple of billion if you can get it, if it's a big enough ETF, to make sure that when the bottom falls or it falls out a little bit, the whole floor doesn't collapse below you. Look at it on their fact sheets, but you can also do look at Morningstar for their ETF ratings. A bunch of other websites have really good ETF DB, ETF trends. Those are really good websites with really good databases that show you liquidity, show you AUM, show you who's backing it too.
When we talked about IPO and we said we'd like to see it settle and maybe 6 months out, check where it's at. You think the same thing is true for ETFs, right? We look at the inception date and see, all right, well, this is a fairly new one. Let's give it some time. Let's get some value trades inside of it before we invest. Yeah. Same rule of thumb.
Yeah, I let them go a few rounds unless it's so hot to try that you got to be a part of it. Like ARK. Kathy Wood came out with a bunch of ETFs in the past couple of years. They were basically sold out before they hit the trading floor because she was, the thing in ETF land for a few minutes there. So some of them move fast like stocks, but I think it's good to let them go a few rounds to make sure that they can be battle tested. The big ones, the SPYs of the world, the QQQs of the world, brought to you by the Invescos, the State Streets, the Fidelities, the Invescos, right? These are the big houses, and this is what they do. But you're also seeing this growth of the white label ETF business. So the four of us could start an ETF tomorrow if we came up with the right idea. You saw Barstool Portnoy, he was backing an ETF. What was it called? Hype or something like that. It doesn't take a lot to get them off the ground. It takes about 50 million to launch an ETF and market it, but you want to make sure it's gone through a few paces and that there's enough belief and conviction among investors, both retail and institutional, before you put your hand on that life raft, because you never know.
They just came out with a short ARK ETF the other day.
EYL ETF.
I'm so down with that. But can I just come back to one thing you asked, Troy? You said 6 months on an IPO. One thing to note about IPOs, a lot of them, traditional ones, is that they do have lockup periods for 6 months, which means that any executives or employees that were granted stock before the company went public typically have to wait 6 months in a lockup period before they can exercise their shares. Why? Because the company doesn't want them to pump and dump as soon as they get their share grant and leave the company, sell their shares and take off. So that 6 month period is a little bit dicey because you could sometimes see a stock fall off all of a sudden. You'd be like, what just happened there? The 6 month expiration popped. A bunch of executives who had a couple of $1 million in stock wanted to cash out so they could rent that house in the vineyard for the summer.
Which might give you an opportunity to get in. Right? You could look at it like that. Yeah. Pearson, thank you for being so patient. You've been unmuted. What's going on?
Hey, everybody. Can y'all hear me?
Yes. How are you?
Perfect.
All right. I got a question, and it might turn into a discussion, but here it goes. I've noticed that 3 out of 4 global recessions have oil as one of its factors, and we know that the American dollar has ties to oil, aka the petrodollar. From your experience, what are those indicators associated with oil prices that are based on the American real exchange rate that I should be considering? And I know there are many factors that go along to it, but what are some areas I should be looking in towards?
I love that you asked this question. Caleb, you want to take this? But Pearson, man, every week, please ask a question. Can you repeat it one more time?
All right.
I know oil, 3 out of 4 recessions, petrodollar.
All right, so I'm going to do it. So I've noticed that 3 out of 4 global recessions have oil as one of its factors, and we know that the American dollar has ties to oil, aka the petrodollar. From your experience, what are those indicators associated with oil prices that are based on the American real exchange rate that I should be considering? And I understand that there are many factors that go into it, but I want to know what places I should be looking to, because I analogy as a thunderstorm. You see the lightning before you hear the thunder. So that's where I'm looking at. What are those anticipatory factors I should be looking into?
You see the lightning before you hear the thunder. I like that.
It's a great question. Caleb, you want to start?
I do, but I feel like I need a Red Bull or something to get this. Well, that's a great question, Pearson. I want you to come on my IGTV lives with some smart questions like that. You are an Investopediac if I've ever heard one. So great question. And you're right. But I also think that if you think about the last one, the last one was COVID related. We can't, that's black swan event out of nowhere, but you did see what happened to oil there. The one prior to that was 2008, 2009. That was a mortgage crisis, liquidity crisis. So not exactly so tied to the petrodollar as you might think. You got to look though, if you're looking for indicators, at a couple of key things. Obviously, futures prices, right? The futures tell you everything. There's something about the options market, the commodities market, because it's so futures oriented that we kind of know where pricing is soft going out a few months. You could look at, right now, you could be looking at the next month's contract. You could be looking at 6 months from now. And if you look at the CME's website, it's a good place to start, or CBOE, you can look at those future contracts and see where pricing is. That's a great place where to start, because options traders, they're the ones that are out there with the weather vanes, to use your weather analogy, going, where is this thing going to be in a few months from now? And they're the ones who will tell you first. So when you see volatility in the oil market and you see those future prices shifting a lot, that tells you there's a storm brewing. How big it will be, we don't know, but that's the first thing you got to watch. And then if you really want to get, down into it, you could be looking at oil rig counts, right? Oil rig active counts out in the Gulf of Mexico, the Baker Hughes oil rig count they do every week, who's producing, who's not producing. You could also look at the supply, the oil inventory supplies through the EIA, Energy Information Agency, EIA.gov. They put out a report every week. If you really want to go deep on that, you can. But for most of us, we're not going to do that, right? We're going to feel the winds blowing from the options market, because it's going to tell you where futures are priced. And it's so sensitive to where future demand is, because remember, oil is a super long-term commodity. Airlines order it sometimes up to a year in advance and pay the price, for today, for what it might cost in a year. They hedge that price. So there's such long-term demand that you kind of going to know what's going to happen before it hits you. I doubt we're going to have an oil shock out of the blue recession like we had in the 70s. We're a different type of global economy right now. And we have all different kinds of ways of powering all the things that we need, besides oil, to get through that type of a crisis. But the futures market's the first place to start. I hope that helped.
Yeah, I would agree 1,000%. Just to piggyback off of what Caleb says, if you guys look at the ticker CL, the futures market, I've always told you, just recently this month, I think we got back to the 50% high from 2008. So at 147.27 was the high. We just got back to 77.09. That's the easiest way to be able to tell. But we've been in a dramatic downtrend ever since then. But any uptick you'll be able to see, and if once we get overpriced, if we ever get back to $100 and definitely hit like $100, 111, like 111.64, we'll see a tailspin back to the downside as well. So and that's why I always tell you guys, like, learning the futures market, even if you don't trade it, as Caleb said, it will tell you an indication of where the market was going to go. Because when we first started doing Market Mondays, I'm like, hey, if the Dow cracks through the 50% retracement of the 10-year, it's going to be game over if they don't do something. So to be able to predict the prices, the futures kind of give you a glimpse, a foreshadowing of what's going to happen, and then the market usually follows. That's why if you turn on CNBC or any stock show, the futures market comes up first, and that'll give you all the insight that you absolutely need. But great question, Pearson. I want to give you a scholarship tonight because your questions are absolutely amazing. So send your email.
Pearson, appreciate you, my guy. Appreciate you.
Yeah, let's get his email, Janet. And yeah, I guess the name is all in the name, the futures, right?
Yeah.
They call it that for a reason, telling you the future. So yeah. It's a high level conversation, man.
Yeah.
They very high level conversation.
They said Caleb is delivering.
That was black belt. That was a tough question. And a small
that was a black belt question. Definitely a black belt question.
Yeah. Man.
Junior, what's going on? You've been unmuted. Unmute yourself.
Hey, good night, fellas.
What's going on?
How are you?
Yeah, we hear you perfect.
Hey. Happy birthday to you, Ian, again. You and my daughter have the same birthday.
Oh, much love to her. Drop your cash up so I can send her a birthday gift.
Yeah, you have.
All right, no problem. My question is for Shadi. So I was working at I want to know, like, I was working at a job. I had a 401k with them, but I left, and that that money's still tied up in that 401k there. I want to move it, but I want to know my best option to move it without to avoid paying the taxes on it.
Yeah, definitely. You want to move into
like what other accounts can I move it to?
Yeah, I'm sure on the site, Caleb, a lot of people ask this question about rollovers. So I would love to get your opinion on it as well. But rollovers, when I was heavy in my financial planning practice, made up about 70% of my financial planning practice. Helping people roll over old 401ks or retirement accounts is very common. And most people, the majority of their investments are in retirement accounts. Like the average person doesn't have $100,000 in a brokerage account or, 300,000 just in their Robinhood account. Some do, but most people don't. But a lot of people have 50,000, 75,000, 100, 200,000 in their 401k. So being that is the majority of a lot of people's assets, it's important to make smart decisions. So you can definitely roll it over into an IRA, but outside of that, I'll say why it's a good idea to roll it over from a 401k into an IRA when the money's out of old 401k is pretty much frozen in a sense. Not frozen where it's not growing, but frozen where you can't borrow from it, you can't add to it. You're stuck whatever choices that the old company provides for you. So like if you have Fidelity, they might give you a menu of like 20 different options that you get to pick and choose from, and you don't really even get customer service help. Like if you call customer service, they can you can tell them what to do. But if you ask them for advice, like legally, they're not going to give you advice over the phone. So you're pretty much just like fending for yourself. And then you might move and then you don't update your address. So it's very problematic to leave an old 401k at your old job. That's just my opinion. So being that you can roll it over into an IRA without, paying any taxes, any penalties, you definitely want to explore the IRA rollover. Now, there's different ways that you can roll it into an IRA. You can work with an advisor and have them help you with it, or you can do it yourself. Any brokerage account, like Fidelity, TD, any of those type of brokerage accounts, you can open a traditional IRA. And then the process is you would call the 401k company. First, you open up the IRA, you get an account number. So then you call the 401k company and you say, I want to roll over this 401k into my IRA. A lot of the companies, especially like Fidelity, they let you do it over the phone, and they send you a check, and then you just forward the check to the IRA custodian. Sometimes you have to fill out paperwork and then they transfer it for you. But either way, you communicate with the 401k company and tell them that you want to roll it over. So you don't necessarily have to know exactly what you want to invest in and roll it over, because it can be held in a money market account, which is like, sitting on the sidelines. And then when you decide how you want to invest, then you can invest the money. Target date funds is always a good option. Similar to how they have with 401ks, a lot of brokerage accounts allow you to invest in target date funds like 2020, 2030, 2040, 2050. The idea with retirement is that you want to be aggressive when you're young and conservative as you get older. So the target date fund automatically becomes more conservative as you get closer to that target date. The target date is the date that you plan on retiring. Of course, you can take, the strategies that we've talked about on Market Mondays, where you can invest in index funds, you can invest in ETFs, you can invest in individual stocks. I wouldn't recommend being too overly aggressive with the retirement account. Yeah, like you don't want to like do a bunch of penny stocks and things of that nature. But I would recommend if you're not going to do the target date funds, maybe have 4 to 5 investments that you want to invest in. I would say the majority should be index or ETF, because that gives you broad range exposure. Like one ETF, you can have 30 different stocks in it. And then of course, with the index, you invest in S&P 500, you have 500 stocks in it. And then maybe if you want to have like 1 or 2 anchor companies like a Microsoft or an Apple, that you feel comfortable with. So yeah, that's my take on it.
Yeah, that's called Rashadopedia right there. We be putting that up on the
zone down. He was like ISO. Go ahead.
He called the ISO, right? ISO.
Good job.
I cleared it out. He said, I'll start moving over.
Well, I'm a facilitator. My role at Market Mondays is the facilitator. We got a great talent in Ian. He's like the Kobe Bryant. And then when we get to bring on guests, it's like an all-star. So me and Troy just more facilitate. We pick our shots here and there. Spot shooters. We're just spot shooters. But every once in a while we get to
clear it out.
Have some and
stuff.
Thank you.
He just came.
Appreciate you, Julian.
He just came in and shot 4 3-pointers, grabbed 5 rebounds.
Real quick.
Yeah.
Going back on the bench now.
Showed up in the fourth quarter, dropped 35 real quick.
Joe's impressive.
Jeremy Lin.
But Rashad, what you mentioned about the check, that you actually get a physical check mailed to you. So people got to pay attention to that if they're going to do that. You get a check like you haven't seen before. If you have a lot of money in there, all of a sudden you're like, oh boy, this is my retirement on a piece of paper. You got to be really careful with that. Take it over to your new custodian or your new broker, wherever you're setting that up. Get that in there as fast as possible. That shocked me when I got mine the first time I rolled over. I was like, whoa. Here's 10 years of work.
Yeah, and a lot of times they send it in regular mail too. So you might have a check for I've seen checks for $1 million, $800,000, and people get nervous. Like they're like, I just got a check for $800,000. What do I do? I'm like, well, forward it to me, and I'll send it. I'll make sure it gets in the right hand.
First thing,
but yeah, no, that's definitely important because a lot of times people and check your mail.
That's true too.
Check your mail too. A lot of times you'd be surprised. A lot of people don't check, including me. I'm terrible at that, but people don't check their mail for weeks at a time. You go on vacation and then it's like, oh wow, what happened? This guy sent 90 days ago and I never did anything.
And it expires in 36 hours.
Very important.
Yeah. Onessa, we coming to you. Unmute yourself. You've been unmuted.
Oh my God. Can you hear me?
Yes, we can.
So excited. Hey guys.
Joy. How are you?
I'm doing good. How are you guys doing? Okay. So here's my question. You guys talk a lot about the 2 index and 2 tech, right? Got that. I've been investing in it monthly. But I really do want to do dividend stocks to diversify my portfolio or whatever. So I was trying to figure out what's the best dividend stocks I should get into to diversify my portfolio next.
If you go look at the episode from 2 weeks ago, I literally put out a list of ones that are upward moving. The thing I want you to be very mindful of, especially when
I have a list of it. I remember when you did that, you said Starbucks, Lowe's, Costco, Nike, AT&T. I got it.
So I hate AT&T. No. I want to be on the record. I hate AT&T.
Okay.
For whatever the dividend pays for the drop that it's had, that is terrifying to me. Now, when my bill was my bill back in the day before Verizon, and there was a whole bunch of
remember that?
Great. But for the last 20 years, I feel like the only thing AT&T is specialized in is paying top dollar for assets at the worst price. So you want your dividend to go up because in theory, I get it. You get a great dividend, but when you actually do it and you're like, the stock dropped 29%, you're not going to be happy with the dividend, especially if it's dragged. Let's say you have a big position and it drags the rest of your portfolio down. You're not going to care about the dividend that it paid. There's a difference between like portfolio management on a paper and like Caleb said, when you're actually doing it and you see the money in there, it is a huge difference. So I would pick ones that have progressively been going up over a 5, 10, 15-year period while giving a dividend, even if it's smaller.
Okay. What's your top 5?
I'm biased, but I know Apple pays a small one, but I like Apple because if I told anyone,
I put Microsoft on my 2 techs, so I got that.
I'll make a list here and drop them for you at the end. Then.
Okay.
But the reason why, for logic reasons, like if I told you I had a dividend company that would do, $14 billion in a quarter and they would be up 93%, you would think that it was a scam. But I think when tech or any quality company is growing over time, the growth of those major tech companies are going to outposition and outpace any traditional dividend. So I know they have like a dividend kings list, but when you ask people that have put in 200, 300,000, 400,000, or if you're doing equal weighted, and let's say you have 10% of your equity in there, it's not fun when those companies drop 20 and 30% out of it. And they cut the dividend when things are not going well. That's not fun.
Yeah.
So be mindful of that. Please be mindful.
Putting a pause on the dividend. Nothing coming out this week. Yo, shout out to that throwback. Remember Bell Atlantic? That turned into Verizon, right?
Yeah.
Which crazy. One was NYMEX? Or the New York? It was one of them. It was one of the bells, but the baby bells have spawned baby bells, and
yeah.
That's a great question.
They had to break it up, right? That was
the Bell Atlantic.
Right? That was a antitrust lawsuit, something with the government.
That's right. Yeah. A very, very popular term and article on Investopedia. But that was a great question, Onessa. And you mentioned dividend kings. There's also dividend aristocrats. There's dividends of all kinds of flavors and shapes. It really depends on what you like for your portfolio, what matches your risk tolerance. But those suggestions are great. And you could literally mix and match the companies you feel comfortable with that pay safe dividends. But if you're looking for growth over time, tougher to find that with dividend stocks.
All right, let's go one more. Thank you. Who is that? Onessa, right? Thank you, Onessa. Let's go to James. James Pleasant, we coming to you. Unmute yourself. You've been unmuted. What's going on?
Five, four.
Damn, fridge break. Sound effects on the way, y'all.
I'm sorry.
Congratulations.
You played yourself.
Let's
go to Odell. Odell Robinson, what's going on? Oh, James is there. James, what's up? Dang, can't get his mic together. Odell, we coming to you. Unmute yourself. You've been unmuted.
a lot of good questions tonight. Let's try to have a
really shit. Can you hear me?
Yes. Yeah, we got you, James. What's up?
Oh, my bad. Hey, I'm a truck driver. My bad. I put my mic on mute so you guys couldn't hear me.
All right, no problem. We respect the truck drivers. Shout out to EYL Demetrius.
When I get back home, when I get my next check, I'm getting in with Alex. Questions for Ian. Ian, can I get a? I'm trying to average down on AMC. I messed up. I don't know what I was thinking. I looking to get into AMD and I got into AMC.
Wait, you try to get AMD?
No. Let's not clown. It's happened.
It happens. It happens all the time.
Finger trade. Yeah, it happens all the time. So what price did you get in on AMC?
I think 59.
Not bad. Well, are you a believer in AMC or no?
I'm so with it.
I would take the loss and just get into AMD then.
Okay.
Yeah, I would take the loss. No, because it's tough because anytime that we average down, and traders, you know this, anytime you get into a trade and you move your stop, you're like, oh man, I just want to get out at break even, and then it gets to break even, then you want to take profit. It's better to just have a small cut.
I'm in the mountains.
Yeah, take the loss on AMC and then just buy AMD instead.
Okay.
Much better company.
Okay.
All right, thank you.
Listen, appreciate you, James.
Thank you.
Appreciate it.
All my truck drivers, listen.
That we've all done that. We've
no trading
all the time. And
no trading
these
and
companies
driving,
go on
y'all.
these long rides because they get somebody get Zoom video communications versus Zoom technologies. How many people bought the wrong Zoom 2 years ago? Plenty of people.
I know 30.
That happens all the time.
Yeah.
I brought I sent the wrong. This was years ago. I was trying to send money to Bitcoin, $500, and I sent it to Bitcoin Cash. I lost $500 because I wasn't paying attention to what I was doing. You got to pay attention. And even this year, I had a remember the caller close as opposed to the caller open.
Yeah.
I had to research Investopedia. I had to find out what the difference between caller close, caller open.
Ian, can you imagine that phone call? Yo, what happened? I'm like, yo, bro, let's walk through what you did. Let's walk through what you did.
Yeah. So it's very important to pay full attention. Never trade stocks or buy stocks when you're like halfway paying attention. That's something I learned. Like if you're with your kids or if you're driving or if you're in a rush to do something, because you want to make sure that you know what you're doing, because once you do it, it's kind of like done at that point.
Hashtag no trading and driving.
Yes.
Make that the hashtag.
This has been definitely a legendary episode. Caleb, thank you for joining us. Just a wealth of knowledge. How have you been able to receive all of this information? Like, do you just read all day, every day? Like how much information do you consume on a daily basis?
I take in a lot. I start early. I start with, a lot of the published trade publications and the journals of the world, the CNBCs. I got that cooking. I got all the biz channels hopping in the morning. I also read a lot of research reports, but I'm a dad. I got a couple of teenage. I read research reports from some of the big institutions, but I also read Lex Sokolin he's a crypto expert. I read a lot from the crypto community, from friends of mine that are in it. I read a fair amount of technical analysis because I'm more of a fundamental guy, but I like to know the dark arts of technical analysis because numbers don't lie, and to understand chart patterns and then mix those with the fundamental research I do. I think that's sort of a powerful combination. It's like my own little martial art, little judo, little taekwondo, little aikido, a little kung fu. So I try to bring all that together. I read some currency stuff, not that I trade currencies. I just want to know sort of what the temperature is around the world for the dollar and for other assets like that. And I read a fair amount of FinTwit because I got a lot of friends on there who are super smart. And I'm constantly learning from them. And I've been a journalist for 25 years. So I got a lot of friends who are authors and great journalists who I follow on the daily. I consume plenty of it. But, for me, and I know you guys probably feel this way too, when you're doing this type of thing, it doesn't really feel like a job anymore. It just feels like this is the extension of myself.
Yeah.
And the biggest thing I can do is keep learning so I can keep teaching, because that's the greatest gift.